Hello, welcome to our new lesson for today. This presentation discusses the concepts of audit evidence and the procedures by the auditor to obtain and evaluate audit evidence. So this is Josie De Leon. I'm going to teach you a valuable lesson again today. So if you're ready, let's start. By the end of this video, you will understand key topics such as auditor objectives and audit evidence classification, the factors affecting audit evidence persuasiveness, general reliability of audit evidence, relationship between sufficiency and appropriateness of evidence, management assertions in evidence collection, major and specific audit procedures and evidence acquisition, types of substantive test procedures, external confirmation procedures execution, analytical procedures as substantive tests, accounting estimates consideration. So these are the relevant PSA references, 500, 501, 501, and 540. 505 and 540, sorry. Now let's talk about the definition of evidence, audit evidence. So it says here that audit evidence pertains to all information used by the auditor in arriving at the conclusions on which the auditor's opinion is based. So it says here that audit evidence includes both information contained in the accounting records, those which are internal, no? Underlying the financial statements and other information. So audit evidence serves as the basis for the opinion being expressed by the auditor on the company's financial statements. So without sufficient and appropriate audit evidence, the auditor will not be able to form and express a fact-based opinion. So as such, the auditor plans and performs the audit with the objective of gathering the required quantity and, of course, the quality of evidence to support the opinion. So based on the audit evidence definition, we have drawn two major concepts. One is the objective of the auditor when gathering the evidence, and the other is the two classifications of audit evidence. Okay, let's start with the objective of the auditor when gathering evidence. So it says here that the auditor designs and performs audit procedures to gather audit evidence. So auditor gathers audit evidence, and so the auditor expresses an audit opinion based on the gathered audit evidence. So simply stated, so without these two, the auditor cannot express his or her own opinion. The second one is the two classifications of audit evidence. Okay. So we have here underlying accounting data and the corroborating information. So let's talk about the definition. So underlying accounting data generally includes information from the management that supports and corroborates their assertions and any information that contradicts such assertions. So examples, the records of initial accounting entries or general journals, supporting records such as checks and records of electronic fund transfers, invoices, contracts, the general and subsidiary ledgers, journal entries, and other adjustments to the financial statement that is not reflected in the formal journal entries, and records such as worksheets, spreadsheets, supporting cost allocations, computations, reconciliations, and disclosures. So the corroborating information naman, it may include information obtained from audit procedures, so performed during audit. So the audit evidence obtained from other sources like previous audits, firm's quality control, for procedures for client acceptance and continuance. So examples, minutes of the meeting, confirmations from third parties, analyst report, comparable data about competitors or benchmarking, internal controls manuals, information obtained by the auditor from audit procedures such as inquiry, observation, and inspection. Other information developed by or available to the auditor that permits the auditor to reach conclusions through valid reasoning. All right, so important notes that we have to consider. So the entity's accounting records cannot be considered, remember the word cannot be considered sufficient evidence to support an opinion on the financial statements. Thus, the auditor must obtain corroborating information to be able to express an opinion. So this alone is not sufficient. it has to include this corroborating information. So to easily classify evidence as underlying accounting data, one distinguishing feature is if the information is used in the accounting process to prepare the financial statements, while other information is a residual definition. That is, if the term is not classified as underlying accounting data, if it's not here, that means it's classified as other information. Okay. Okay, now let's go to sufficient and appropriate audit evidence. Okay, so PSAs require the auditor to design and perform audit procedures that are appropriate in the circumstances for the purpose of obtaining sufficient appropriate audit evidence. So when you design and perform audit procedures, as an auditor, you should consider the relevance and reliability of the information to be used as audit evidence. So in this diagram, you can see the determinants that affect the overall persuasiveness of audit evidence obtained. Okay, now let's discuss this in details. Sufficiency, which is the measure, remember, sufficiency from the word sufficient, it's related to quantity of the audit evidence. So the required quantity of evidence is affected by the following. So the auditor's assessment of the risk of material misstatement. So it says here, the impact niya is the higher the assessed risk, the more audit evidence is likely to be required. While the quality of such evidence, so here, the higher the quality, if you talk about the quality, if the quality is high, then the less may be required. It means the less audit evidence. So let's put it this way. So this one, quantity high, evidence also high. While here, if the quality is high, then evidence is less is required. All right, remember this opposite, okay, the relationship. Okay, the second determinant of persuasiveness of audit evidence is the appropriateness. It is the measure of the quality of audit evidence. So before it was sufficiency or the quantity, this one is appropriateness. The word appropriate, it means quality. Okay. Quality is determined by its relevance and reliability in providing support for the conclusions on which the auditor's opinion is based. Okay, let's discuss first the relevance. Relevance, okay, it means it's related to the assertion from the word relevant, related. Relevance deals with the logical connection or bearing upon the purpose of the audit procedure and, where appropriate, the assertion under consideration. So the relevance of the information to be used as audit evidence may be affected by the direction of testing, as shown in the next slide. Okay, but before we go there, let's talk about reliability shortly. Evidence is regarded as reliable if it is dependable to signal the true state of an assertion. From the word reliable, it is influenced by its source and its nature and the individual circumstances under which it is obtained. Okay. So when you say from reliable, we don't rely on fake news. Examples. When testing for understatement of accounts payable, okay, testing recorded accounts payable would not be relevant anymore because we're talking about, for example, testing of accounts payable. So when we test the understatement of accounts payable, so irrelevant na yung recorded accounts payable. Why? Because we're talking about understatement. That the recorded accounts payable is no longer relevant to what we are going to do. So the relevant testing is the examination of subsequent disbursements, unpaid invoices, suppliers' statements, and unmatched reports. Because we're looking for those transactions which are not yet recorded. All right? Because recorded accounts payable, they're already recorded, so that's not relevant anymore. So why do we have to examine subsequent disbursement? Subsequent disbursement, for example, your cutoff is usually the cutoff is end of the month or end of the year. So the audit is usually end of the year. So December 31, then you have subsequent disbursement. You paid a supplier on January, let's say January 1 or January 2. And you need to check if that payment of or the transaction was also recorded in the accounts payable as of December 31st. Then unpaid invoices. For example, you have you started vouching or looking for the list of invoices, or even for example the stock of invoices from your client, and then you saw some invoices which are for example on the table of the accountant, but it's not in the accounts payable ledger. So that means there is unrecorded. That's why it says here under statement there are unrecorded invoices which should be part of that accounts payable. The supplier statements. When you send a confirmation letter to the supplier or to the vendor, then the supplier said that, oh, okay, client ABC, your client, which is your client ABC, they owe us 100,000. And then when you check the accounts payable of the client, those particular invoices are not recorded in the accounts payable. So that's why these are all relevant. And of course, unmatched reports. All right. So the other one, so when you're testing for overstatement of accounts receivable, so testing the recorded accounts receivable may be a relevant audit procedure. So it says here, testing the recorded accounts receivable, which can be accomplished by inspecting source documents of the recorded receivables, such as sales invoices, shipping documents, and sales orders, and inspection of documents related to collection of receivables after the end period. Yung sales invoices, no? For example, you made a sale in January 1st or January 2nd, but you already included that in your sales for December. So of course your entry there is going to be AR debit, debit AR and credit revenue. So now your AR is overstated as well as the revenue. Okay, moreover, a given set of audit procedures may provide audit evidence that is relevant to certain assertions but not the others. Okay, on this slide, we can discuss few more audit procedures as our examples. Okay, the first one, physical examination of tangible assets. So the physical examination of tangible assets may provide sufficient evidence when the auditor wants to determine the existence and condition of the assets, but not necessarily for rights and obligations. The second one, inspection of documents related to the collection of receivables after the period end may provide audit evidence regarding existence and valuation, but not necessarily cut off. The last one is the test of controls. Test of controls will provide relevant audit evidence when the auditor is evaluating the operating effectiveness of controls. On the other hand, substantive procedures will provide relevant audit evidence if the auditor wants to detect material misstatements at the assertion level. It is also worth noting that audit evidence from various sources or of a different nature may often be relevant to the same assertion. Okay, document authentication is rarely part of an audit, and the auditor lacks expertise in it. The auditor evaluates the reliability of photocopies, facsimiles, film, digitized, or other electronic documents used as audit evidence, including controls over their preparation and maintenance. Getting consistent information from diverse sources or types of audit evidence boosts its dependability. However, when audit evidence from one source is inconsistent with that from another, or the auditor doubts the reliability of audit evidence, the auditor must determine what modification or additional audit procedures are needed to resolve the matter. Okay, while recognizing that exceptions may exist, This slide shows some generalizations about the reliability of audit evidence. For example, internal versus external sources. It says here, audit evidence is more reliable when it is obtained from independent sources outside the entity. Second one, effective versus ineffective controls. Audit evidence that is generated internally is more reliable when, the word when, the related controls, okay, controls imposed by the entire entity are, this is the word, effective. The next one, directly versus indirectly obtained evidence. So audit evidence obtained directly by the auditor, for example, observation of the application of controls is directly, okay, is more reliable than audit evidence obtained indirectly, or by inference. For example, inquiry about the application of a control. Okay. Written versus other forms. Audit evidence is more reliable when it exists in documentary form. It's written, whether paper, electronic, or other medium. For example, a contemporaneously written record of a meeting is more reliable than a subsequent oral representations of the matters discussed. The next one is original versus reproduction. Reproduction is like photocopying. Audit evidence provided by original documents is more reliable than audit evidence provided by photocopies or facsimiles. Okay. So as shown in previous slide, the sufficiency and appropriateness of audit evidence are interrelated. The evidence, the required quantity of audit evidence is affected by the auditor's assessment of the risk of material misstatements. So here, okay, sufficiency, quantity, right? Sufficiency or the quantity, and this one is the appropriateness or quality. If the assessed risk is high, that's what we were talking a while ago, no? If the assessed risk is high, audit evidence required is more, or I just use an arrow high. That's how I look at it. But for the quality, if the audit evidence is high, then the audit evidence required now is less. That's how I look at it. Okay. Now let's go to gathering audit evidence. Okay. Management is responsible for the fair presentation of financial statements that reflect the nature and operations of the entity. All right, remember, it is the management who is responsible for the fair presentation of financial statements. So in representing that the financial statements are presented fairly, it didn't say here 100% correct. It says here fair. So management implicitly or explicitly makes assertions regarding the recognition, measurement, presentation, and disclosure of the various elements of financial statements and related disclosures. So the management assertions are used by the auditor in designing audit procedures. Right. So these assertions serve as targets or objectives over which audit procedures to be formulated should be directed. So it says here the auditor sets objectives by considering management assertions. All right. So remember that the auditor's target, it starts from the management's assertion. For this one, this is the goal. Remember the goal, you have something like this, and this is your target. This is the goal based on management's assertions. Okay. The next one, the auditor designs specific procedures to address the objective set. So this is number 2. And then number 3, the auditor performs specific procedures directed towards FS assertions. So first, you design or you set your objective. The second one, you start preparing the procedure. So these are checklists or procedures. Okay? That's number 1, number 2, number 3, number 4. These are their checklists. Okay. And the third one, you start performing, right? So you start performing the procedures based on these two that you did as an auditor. right? So my drawing is really, it's really bad. All right. Okay, now let's go to the next slide. Here, we'll discuss a little bit about the evidence gathering procedures. There's major audit procedures and there's also specific audit procedures. So the auditor gathers audit evidence to draw reasonable conclusions on which to base the audit opinion by performing the following evidence gathering procedures. Okay, for the major audit procedures, okay, we have the risk assessment procedures and we have further audit procedures. So under further audit procedures, we have this test of controls and substantive testing. And then we have at the left here, the specific audit procedures. So here on this slide, you can see summary of the types of evidence gathering procedures. It also shows the applicability of specific audit procedures to major audit procedures. Like for example, let's go to inspection. So it says here the specific audit procedure of inspection is also because it's under the risk assessment procedure. That's also part of the test control and substantive testing. Now, if you go to the confirmation, for example, this is only substantive testing. Okay, I will not discuss this one by one, but you can screenshot this for your own reference. Let's go to the next slide. Let's look at the major audit procedures. Okay, so we have three: the risk assessment, test control, and substantive test. Risk assessment procedures are procedures which will enable the auditor to obtain understanding of the entity and its environment, including its internal control, to assess the risk of material misstatement at the financial statement and assertion levels. The auditor always performs risk assessment procedures to provide satisfactory basis for the assessment of risk at the financial statement and assertion levels. This is basically like a high level. This is the initial one. So the auditor would know where to focus. The higher the risk, that's where they're going to focus more energy and efforts. All right. So the risk assessment procedure by themselves, they do not provide sufficient appropriate audit evidence on which to base the opinion. However, and are supplemented by further audit procedures in the form of tests of controls when necessary and substantive procedures. Okay, now let's go to the test of controls. So tests of controls are procedures designed to evaluate the operating effectiveness of controls in preventing, detecting, and correcting material misstatements at the assertion level. So the testing of control is basically testing and, by observing, reperforming, and testing to see if the management's control or the internal control is actually effective. So that's why it's here operating effectiveness. Usually in big companies, there are internal control procedures. So from the management side, of course, the management has the responsibility to make sure that there's a tight internal control and it's also working effectively. Now let's go to the substantive testing. So these substantive tests, these are procedures designed to detect material misstatements at the assertion level. It includes tests of details of classes of transactions, account balances, and disclosures, and substantive analytical procedures as well. So substantive tests, the auditor there's always a performance of substantive testing of the financial statements. Okay. Now let's go more details with specific audit procedures. Okay. We can go through one by one. Inspection of records, examination of internal or external records or documents in paper form, electronic, or other media. Inspection of tangible assets. These are physical inventories by going to for example, the warehouse or looking at the stations. You see there are computers, so you know there are computers. Those are tangible assets. Okay, so it may provide reliable audit evidence with respect to existence. So, for example, in the books, it says there, we have a building. You can take a look. There's a building, yes. You have a warehouse. You can go to the warehouse and see. Okay, it's a big warehouse, small warehouse. Okay, check. And for example, it says here, there's a machinery. There's a big machinery. Then You look at the machinery. Okay, there's a machinery. In the books, there's also says here, okay, we have delivery truck. You go check the delivery truck. Does it exist? Yes, it exists. There's a delivery truck. Observation. Looking at the process or procedure being performed by others. If, for example, someone is doing preparation of journal entry, we could just observe how someone is doing that by creation of the journal entry all the way to the posting of the journal entry in the system. Inquiry. Seeking information from knowledgeable persons, both financial and non-financial, throughout the entity or outside the entity. So this includes, it's like an interview to the personnel. Confirmation. Process of obtaining a representation of information or of an existing condition directly from a third party. Confirmation, there's a separate topic on the of confirmation in the next few slides. So we will discuss this further. Reperformance. Examination of internal or external records or documents in paper form, electronic, or other media. Analytical procedures. These are evaluations of financial information made by study of plausible relationships among both financial and non-financial data. So the very basic analytical procedure is you have sales from prior year, sales this year. You just compare and ask questions. If, for example, you have a threshold of 10%, for example, any deviation or fluctuation more than 10%, then you ask questions. For example, the cash from prior years, 1 million, the cash this year is just 500,000. There's a difference of half, 50% already. So you ask the question to the client what happened. Okay. Recalculation consists of checking the mathematical accuracy of documents. So this includes footing, no? Like for example, we have 10 line items. Some of these are being done, most of these are being done through computers. But when I was doing the audit, I still do manual calculation because sometimes, they give you something in paper. It's something that's already printed. And sometimes the formula doesn't include the last line. So I usually have issues with the footing. So yeah, I always use my calculator to add it manually. Okay. Other general concepts related to audit evidence. So persuasiveness of evidence, you have the cost-benefit consideration, and the sources of evidence. So the persuasiveness, auditor ordinarily finds it necessary to rely on audit evidence that is persuasive rather than conclusive because limited time in nature of evidence. That's what I was telling to you. It's not 100% that you will get 100% correct answers. Something only that's persuasive, something that will make you think that, okay, I'll rely on this because it makes me believe that this is fair. Okay. Cost-benefit consideration. The auditor considers the relationship between the cost of obtaining audit evidence and the usefulness of the information obtained, unless there's no other alternative. So for example, if it takes a lot of time and effort and also cost money for the client and for the auditor to obtain the information, then you will just rely on alternative procedure. Sources of evidence. Audit evidence is cumulative in nature. Audit evidence may come from previous audits, firms' quality control procedures, and entities' accounting records. Okay, now let's go to the types of substantive procedures. All right, test of details. Test of details dig into specific transactions or balances to verify their accuracy. One is the classes of transactions, account balances, and quantitative and qualitative disclosures. Examples: verifying invoices, contracts or ledgers, confirming receivables or payables, examining supporting schedules. Substantive analytical procedure. So when results, as I mentioned to you, if there's a deviation or fluctuation, a big fluctuation from expectations, it signals possible misstatement. Okay. Classes of transactions, account balances, and quantitative disclosures. Examples: comparing financial data with expectations. Expectations is like the budget or the forecast or You expect because the client told you that there's an increase of sales from prior year by about 10%. Then you look at the financial statement. Then you look there, okay, did we increase our revenue? So if the revenue is increased, so what you obtained from the client based on the client's interview or inquiry is correct. But if the client was telling you, or the management was telling you that, oh, our revenue has increased by 10%, but then when you look at the financial statement, it decreased by 20%. So something is wrong. So it means that the management is not telling you the truth. The second one is identify unusual trends or variances. Okay. The decision as to which type of procedure should apply is based solely on auditor's judgment after consideration of information obtained during the risk assessment. That's what we call professional judgment. So now let's dig deeper into test of details. Test of details are procedures performed by the auditor to gather evidence that the actual details of balances, disclosures, and underlying transactions associated with an entity's financial statements are fairly stated. So the test of details are the auditor's primary responses to risk of material misstatements. When performing test of details, the auditor may choose between the test of transactions and test of balances. So test of transactions and events is generally used when auditing statements of financial performance accounts, while test of balances is used to audit ending balances of statement of financial position accounts. The test of transactions and events is applied to account balances comprised of small volume of transactions but material amounts. While the test of balances, it is used to audit ending balances of statement of financial position accounts or account balances with large volume but relatively low values. So generally, test of transactions in events and test of balances are applied to the following account balances. Okay, test of transactions in events. Property, plant, and equipment. Audit of additions, example, audit of additions, disposals, depreciation, and impairment. Intangible assets, example, audit of additions, disposals, amortizations, and impairment. Bonds payable, audit of issuance, repayments, and interest amortization. And the shareholders' equity accounts, the audit of share issuances, share repurchases, and payment of the dividends. For the test of balances, for example, cash, we audit the existence, now if there's really cash, completeness, rights, and valuation of ending cash balance. For accounts receivable, we audit the existence, completeness, rights, and valuation of ending accounts receivable balance. Inventories, of course, the existence, completeness, rights, and valuation of ending inventory balance. And for the accounts payable, existence, completeness, obligations, and valuation of ending accounts payable balances. The nature, timing, and extent of substantive procedures to be applied by the auditor will be dependent on the level of planned detection risk. Remember, there is an inverse relationship between detection risk and the assurance provided by the substantive procedures. So if the auditor would like to reduce detection risk, the auditor needs to perform more effective procedures. So this table on this slide summarizes the effect of detection risk on the nature, timing, and extent of audit procedures. For example, the nature related to quality of evidence to be obtained. Lower detection risk, it means you have to apply more effective procedures. If it's above minimum detection risk, okay, less effective procedures may be applied. Timing, related to the period in which evidence applies. So apply procedures closer or nearer to the year end. And if it's above minimum detection risk, procedures may be applied at interim or multiple points in time. For the extent, related to quantity of evidence to be obtained, we have to increase the extent of substantive procedures to gather more evidence if there's a lower detection risk. And the auditor may reduce the extent of substantive procedures if it's above minimum detection risk. All right, the specific procedures that may be applied as substantive procedures include inspection, observation, inquiry, recalculation, confirmation, and analytical procedures. So for the next few slides, we will only focus on these two, the confirmation and the analytical procedures. Okay, when using, this is what I mentioned to you, no? This is for the confirmation. When using external confirmation procedures, the objective of the auditor is to design and perform such procedures to obtain relevant and reliable audit evidence. Right. External confirmations are frequently used in relation to account balances and their components, but need to be restricted to these items. For example, the auditor may request external confirmation of the terms of agreements or transactions an entity has with third parties. Okay. And these are the examples of external confirmations. Investment purchased from stockbrokers but not delivered at the reporting date. Property title deeds held by lawyers or financiers for safe custody or as a security. Accounts payable balances to our suppliers, Bank balances and other information from the bankers. Accounts receivable balances. We send the confirmation to the clients. Loan from lenders. Lawyer, legal counsel confirmations. Inventories held by third parties at bonded warehouses for processing or consignment. And then the terms of agreements or transactions an entity has with third parties and details of modifications, if any. Okay. And the last one is the absence of certain conditions, such as a side agreement. Okay. Types of external confirmation. We have two types of external confirmation, the positive and the negative. Okay, let's start with the positive confirmation. A positive confirmation is a request sent to a third party asking them to respond directly to the auditor, indicating whether they agree or disagree with the information stated in the request. The third party must reply in all cases. Either they agree or disagree, they must reply in all cases, either to confirm of the information or to note any discrepancies. For example, an auditor sends a letter to a customer of the audit client stating, please confirm directly to us whether the balance of $10,000 as of December 31, 2023, owed by you to XYZ company is correct. If not, please provide the correct amount. So the customer is required to respond whether or not they agree with the stated balance. So positive confirmation is used when the information available to corroborate management's information is only available outside the entity. The entity's information systems and internal controls are unreliable or ineffective. The control risk is high, leading to higher risk of material misstatement and or specific fraud risk factors such as risk of management override of internal controls prevent the auditor from relying on evidence from the entity. High risk of material misstatement. While for the negative confirmation, so a negative confirmation is a request sent to a third party asking them to respond to the auditor only if they disagree. Only if they disagree with the information stated in the request. So if the third party does not respond, it is assumed that they agree with the stated information. For example, please inform us only if the balance of $500 as of December 31, 2023 owed by you to XYZ company is incorrect. So meaning if this $500 is correct, they don't need to respond. So we use negative confirmation when the auditor concluded that the risk of material misstatement is low. Okay. The population of items comprises a large number of small. It means volume is high. Okay. Very few or no exceptions expected. The auditor has no reason to believe that recipients of negative confirmation requests will disregard such confirmation. So, meaning there's more, the internal control and the numbers or the balances are quite reliable. So that's why they're using the negative confirmation. All right, summary of differences between positive and negative confirmation. Okay, so responses, positive, agree or disagree, they have to respond. Negative, respond only if the information is incorrect. There's an example in the related risk of material statements. So for positive, the entity's information systems and internal controls are unreliable. So this is what I'm saying, unreliable. This one, unreliable and ineffective. Okay, concluded from the word for the negative one, material misstatement is low. Okay. Availability of resources, information available to corroborate management's assertions only available outside the entity. While for the negative, information available to corroborate management's assertions available within and outside the entity. Characteristics of items involved. Population of items comprises small number of large account balances. This is the volume. Volume is high. The population comprises small number of large account balances, while for the negative, the population of items comprises a large number of small homogeneous account balances. So here, the volume is low, account balance is high. For the negative confirmation, the volume is high, balance low. Or the individual balance is low. While here, the volume is low, the account balance is high. It's the other way around. All right. Okay, now let's go to analytical procedures. Analytical procedures are audit techniques that involve evaluating financial information by studying plausible relationships among both financial and non-financial data. Auditors use analytical procedures to identify fluctuations, trends, or inconsistencies that might indicate potential misstatements in the financial statements. Okay, analytical procedures may be used as substantive procedures. This procedure may be less effective compared to test of details, but may be applicable to some account balances, depending on the evaluation of risk. This procedure enables the auditor to gather sufficient appropriate evidence. So when using substantive analytical procedures, the objective of the auditor is to obtain relevant and reliable audit evidence. Okay. Analytical procedures as substantive procedures. First, we determine the suitability of using substantive analytical procedure. Next, develop an expectation of recorded amounts or calculated ratios. Next, evaluate the reliability. Remember, reliability of data used to develop an expectation. And that's where we're going to base the next one. Evaluate whether the expectation is sufficiently precise to identify misstatement. So as I mentioned to you, we are expecting, for example, the trend or the industry benchmark, all manufacturing of certain product will increase. So we estimate or we expect that there's also an increase in the revenue for this year. Now determine the difference between recorded amounts and recorded values that is acceptable without further investigation. Okay. If analytical procedures identify fluctuations or relationships that are not consistent, the auditor shall investigate such differences by, of course, first is inquiring to management and obtain appropriate audit evidence. Next is perform other audit procedures as necessary in circumstances such as corroboration of management responses. Okay, analytical procedures in the overall review. The objective: to design and perform analytical procedures near the end of the audit that assist the auditor when forming an overall conclusion as to whether the financial statements are consistent with the auditor's understanding of the entity. Second, concluding analytical procedures. The conclusions drawn from the results of analytical procedures designed and performed are intended to corroborate conclusions formed during the audit of individual components or elements of the financial statements. The performance of additional procedures. So if there are any anomalous or unexpected account balances that were not found in earlier audit phases, the auditor must decide if additional audit procedures or process are needed to reach a conclusion. So even with strong evidence, absolute assurance is actually impossible. Auditing provides reasonable assurance only. So these are the limitations of audit evidence. They are persuasive, but not conclusive. Limitation on the sampling risk. It could be human error or fraud concealment. Now let's go to auditing accounting estimates. Because of the uncertainties inherent in business activities, some financial statement items can only be estimated. So further, the specific characteristics of an asset, liability or component of equity, or the basis of or method of measurement prescribed by the financial reporting framework may give rise to the need to estimate a financial statement item. Okay, let's talk about the definition. Discuss the definition of an accounting estimate. An accounting estimate is a monetary amount for which the measurement in accordance with applicable financial reporting framework is subject to estimation, uncertainty, or the susceptibility to an inherent risk, lack of precision in measurement. So the term used for an amount measured at fair value where there is estimation uncertainty, as well as for other amounts that require estimation. So let's see the next slide for examples of accounting estimates. Okay, accounting estimates, allowance for doubtful accounts, inventory obsolescence, warranty obligations, depreciation method, the estimated useful life of an asset, provision against the carrying amount of an investment where there is uncertainty regarding its recoverability, the outcome of long-term contracts, and costs arising from litigation settlements and judgments. Fair value accounting estimates, complex financial instruments which are not traded in an active and open market, share-based payments, property or equipment held for disposal, certain assets or liabilities acquired in a business combination, including goodwill and intangible assets, and transactions involving the exchange of assets. Management responsibility. Let's talk about management responsibility. So the management responsible for making accounting estimates and presenting the required disclosures in the financial statements. The determination of these accounting estimates may be simple or complex depending upon the nature of the item. Also, these accounting estimates may be determined as part of the routine accounting system, for example, operating on a continuing basis, or maybe a non-routine, for example, operating only at the period end. The auditor's responsibility, so that the risk of material misstatement is greater when accounting estimates are involved. Thus, PSA 540 requires the auditor to obtain sufficient appropriate audit evidence regarding accounting estimates. The auditor should determine whether accounting estimates included in the financial statements are, first, reasonable in circumstances, objective, consistent application of the accounting policies and consistent with industry guidelines, and properly accounted for and appropriately disclosed. All right, I think that's the end of our lecture. Now we're going to try to answer some CPADE type exam questions. I prepared 20 questions with suggested answers. And if you're ready, let's test your knowledge and let's answer them together. Okay, for question number 1. Which of the following is the most valuable form of audit evidence? A, evidence obtained from the client's records. B, evidence obtained from independent external sources. C, evidence generated internally by the client. D, oral representations by management. Okay. The correct answer is letter B. Evidence obtained from independent external sources. So, evidence from independent external sources is more reliable than evidence from within the client because it is less likely to be manipulated. All right, let's go to question number 2. What is the primary purpose of substantive testing in an audit? A, to test the effectiveness of internal control. B, to detect material misstatements in financial statements. C, to evaluate the efficiency of business operations. And D, to prepare the audit working papers. Okay, you may pause the video to think. The correct answer is letter B, to detect material misstatements in financial statements. Substantive testing aims to detect material misstatements in the financial statements either due to errors or fraud. Okay, now let's go to question number 3. Which of the following is not a type of audit evidence? A, physical examination. B, analytical procedures. C, confirmation. D, budget preparation. You may pause the video to think. The correct answer is letter D, budget preparation. So, budget preparation is not an audit procedure. It is a management responsibility. Okay. Let's go to question number 4. Which assertion is tested when an auditor examines supporting documents for recorded transactions? A, existence. B, completeness. C, rights and obligations. And D, valuation and allocation. You may pause the video to think. The correct answer is letter A, existence. Examining supporting documents for recorded transactions tests whether the transactions actually occurred. So it's the existence. Okay, now let's go to question number 5. Which of the following procedures is primarily used for gathering evidence regarding the valuation assertion? Letter A, observation. B, recalculation. C, inquiry. And D, inspection. You may pause the video to think. The correct answer is letter B, recalculation. So recalculation helps ensure that amounts are recorded at their proper values. Moving on to question number 6. When an auditor sends a confirmation to a debtor, which assertion is being primarily tested? A, completeness. B, existence. C, rights and obligations. And letter D, presentation and disclosure. You may pause the video to think. The correct answer is letter B, existence. Confirmation sent to debtors primarily test the existence of receivables. Okay, let's move to question number 7. Which of the following provides the least persuasive audit evidence? A, written representation from management. B, observation of physical inventory. C, bank confirmation. And letter D, vendor invoice. You may pause the video to think. The correct answer is letter A, written representation from management. So the written representations from management are less persuasive than external or physical evidence. Okay, now let's go to question number 8. Which type of substantive procedure involves comparing amounts, ratios, and trends to expectations? A, analytical procedures. B, inspection. C, confirmation. And letter D, inquiry. You may pause the video to think. The correct answer is A, analytical procedures. Analytical procedures involve evaluating financial information by studying plausible relationships among data. Moving on to question number 9. An auditor's working papers serve primarily to provide a basis for the audit opinion. B, replace client accounting records. C, serve as evidence in court. And D, be used by management for internal control purposes. You may pause the video to think. The correct answer is letter A, provide a basis for the audit opinion. So working papers provide the principal support for the audit opinion. Moving on to question number 11. Which statement about audit evidence is correct according to Philippine standards on auditing? A, audit evidence must be conclusive. B, audit evidence must be persuasive. C, audit evidence must be irrefutable. And letter D, audit evidence must be infallible. The correct answer is audit evidence must be persuasive. So audit evidence should be persuasive rather than conclusive. Moving on to question number 12. Which of the following is not a substantive procedure? A, test of controls. B, substantive analytical procedures. C, test of details. D, vouching. The correct answer is test of controls. Test of controls evaluates the effectiveness of internal controls, not substantive testing. Okay, let's now move to question number 13. What is the best audit procedure to verify the existence of cash? A, inquiry. B, observation of the counting of cash. C, analytical procedure. And D, calculation of the cash receipts. You may pause the video to think. The correct answer is letter B, observation of the counting of cash. Okay. Now let's go to question number 14. Which characteristic does not describe sufficient and appropriate audit evidence? A, quantity. B, quality. C, timeliness. And D, relevance. So you may pause this video to think. The correct answer is letter C, timeliness. Timeliness is important for audit procedures, but not a direct characteristic of audit evidence. Okay, moving on to question number 15. The risk that an auditor fails to detect a material misstatement is known as A, inherent risk. B, control risk. C, detection risk. And letter D, business risk. You may pause the video to think. The correct answer is letter C, detection risk. So detection risk is the risk that audit procedures will not detect a material misstatement. Question number 16. Which of the following is an example of a substantive test of details? A, reviewing board minutes. B, recomputing depreciation expense. C, assessing control environment. And D, inquiring about subsequent events. Okay, you may pause the video to think. The correct answer is letter B, recomputing depreciation expense. Okay, now let's go to question number 17. When an auditor selects a sample of sales invoices and checks them against shipping documents, which assertion is primarily tested? Right, remember, sales invoices against the shipping documents. A, completeness. B, occurrence. C, rights and obligations. And D, classification. You may pause the video to think. The correct answer is letter B, occurrence. So when you check the sales invoices against the shipping documents, you check that something really happened. There's really a sales involved. So that's from the word occur. Something occurred, something has occurred, or the sales has occurred. Moving on to question number 18. Which of the following is not a factor affecting the reliability of audit evidence? A, source of the evidence. B, effectiveness of clients' internal controls. C, auditor's level of professional skepticism. And D, auditor's remuneration. Oh, this is very easy. All right, you may pause the video to think. The correct answer is letter D, of course, auditor's remuneration. Has nothing to do with the reliability of audit evidence. All right, question number 19. Which of the following best describes vouching in substantive testing? A. Examining supporting documents for recorded transactions. B. Ensuring all transactions are recorded. C. Comparing current year balances with prior year. And D. Observing physical assets. You may pause the video to think. The correct answer is letter A. Examining supporting documents for the recorded transactions. Okay, for our last question, which type of audit evidence is generally more reliable? A. Evidence obtained indirectly. B. Evidence obtained directly by the auditor. C. Evidence obtained from the client's staff. Okay. And D. Evidence based on inquiry. This is also easy question. You may pause the video to think. The correct answer is letter B. Evidence obtained directly by the auditor. If the evidence is directly obtained by the auditor, that is more reliable than indirectly obtained, and also more reliable than what you get only from the client staff, from the accountant or assistant accountant or manager. It's also more reliable than just mere inquiry to the management. All right, that wraps up our session. Thank you for watching. I hope you learned something for your CPALE review. So don't forget, please, to subscribe, and I'll see you on my next tutorial. Thank you.